In this episode, you're going to learn all about how to get started with options trading. I am Pranav VK, the CEO and founder of the Intraday Expert. And if you're somebody who's willing to start options trading or just want to learn how exactly options work and what exactly options are, then this series is absolutely for you. So let's get started with the first topic today. So to get started with the first episode, we're going to cover three topics. So first, for you to understand what exactly is options, you need to understand what are the different segments in the stock market. So in the big umbrella of stock market, where exactly does options come into picture? So that is the first thing that we're going to cover, the different segments. So once you have understood the different segments in the market, the second thing I'm going to cover is what exactly is the derivatives. And in derivatives, why are we choosing options? And once we understand these two things, that is when we are going to get into the first topic, that is call options. So I'm going to give you a very simple example where you're going to understand what exactly is a call option and how you can identify which has a higher probability of profit by default and which you can choose to make higher profits. Right. So let's begin with the first topic, that is segments. So starting with the first segment, I want you to understand where exactly does options come into picture in the bigger umbrella of the stock market. So considering this is the stock market, so what are the different segments that we do have? The first thing is we have equity markets, and then we have the derivative markets, currencies or foreign exchange, and we also have commodities, right? So under derivatives, again, we have two sections. The first section is futures, and the second section is options. So whenever we start the journey as a trader, most people start their journey at equity. And once they get into equity, they're bored of it or they don't make much money over there. So that is when they get into either futures or options, or some people also get into, currencies, or they also get into commodities. And then they work their way back down to equity. But in any case, I would always recommend that start your journey with equity so that you get to learn the nitty-gritties of the markets. And once you learn about equities, then get down into futures, options, currencies, or commodities, whatever suits you best and whatever that you would like to actually trade and whatever makes sense to trade for you based on the goal that you have. Right. So now that you have understood that derivatives is the main segment under which futures and options come into picture, almost 80% of the trading happens in options, whereas only 20% of the trading happens in the futures market. And that is the reason why options has one of the highest liquidity even compared to the futures market. Right. So now we are going to talk about options, and in options, there are two types of options. The first one is called as a call option, and the second type of option is called as a put option. Now that we've understood what is the stock market in the basics of stock market series, now we have come down to derivatives. And in derivatives, let's understand what is derivatives. And after we complete that, we'll get into options. And in options, we're going to understand what is a call option and what is a put option. And once we come into call option, put option, again, we have an option to sell in a call option or buy a call option, sell a put option, or buy a put option. Now, this is where most people get confused. They think that call option is buying and put option is selling. This is totally wrong. What you have to understand is that you can do selling and buying both in a call option as well as put options, which means you have four different options that you can go forward with. If when you come to the options market, you can either buy a call option or sell a call option, and on the other hand, you can also sell a put option or buy a put option. So let's start with what exactly is derivatives. So to help you understand what exactly is derivatives, I've created a small diagram over here. So derivative is basically any contract between two individuals where you can actually either buy or sell the underlying asset, and the value of this contract is dependent on the underlying asset. So the underlying asset could be a stock, index, currency, or a commodity. So let me give you a simple example for understanding what a derivative means. In simple terms, let's understand milk and butter. Let's assume that milk is the underlying asset and butter is the contract. If the value of milk goes up, what is going to happen to the value of butter? Is it going to go up or down? Yes, it is going to go up. And if the value of milk comes down, the value of butter also comes down, right? So the value of butter is dependent on the value of milk. So similarly, derivatives are basically contracts between two or more people where the value of this contract is dependent on the underlying asset. So this is, in simple term, a derivative where the contract value is derived from another asset. Now let's understand what exactly is a call option. So to give you an example of a call option, I'm going to consider two names. Let me consider one name, Abhishek. Okay. And the other name, let me take myself, Pranav. Okay. So Abhishek owns a property and the value of this property is, let's say, 50 lakh rupees. And he assumes that the value of this property is going to go down and that is why he wants to sell. Whereas Pranav has some kind of an inside information, or he has some information because of which he feels that the value of this property is going to go up in the future. And that is why he's willing to buy this property. But Pranav is not very sure. So let's say, for example, this is a property where there is going to be a lot of development that is going to come up, okay, in the near future. And if this kind of development actually happens, then the value of this property is going to go high. But if the development does not happen, then probably the value might stay same or go down. So what are the three things that can happen? The value of the property can go up, it can go down, or can stay same. So what is Pranav going to do? Pranav is going to say to Abhishek that, hey Abhishek, here's what we're going to do. Let's get into a contract where we are going to fix the time. Okay. So let's say 6 months, which means after 6 months, Pranav can decide whether he wants to buy the property or not. And for Abhishek to wait for 6 months, he's going to pay a premium of 1 lakh. Pranav is going to pay Abhishek a premium of rupees 1 lakh, which is non-refundable. Once paid, it is done. And Abhishek has to wait for a period of 6 months. And the value at which this contract has been made is 50 lakh rupees. So irrespective of what the market value of the asset is going to be after 6 months, Pranav is only going to pay 50 lakhs to Abhishek, and that is also not guaranteed. Only if Pranav feels that this value is going to be worth it, only then he's going to pay the 50 lakhs. So now let's look at the three conditions where the value of the property is going to go up, it's going to stay the same, or go down. And in each of the cases, who is going to be benefited and who is going to be not. Okay. So let's consider these three scenarios. Value goes up, value goes down, value stays the same. And when it goes up, assume it's going to be 60 lakhs. And when it goes down, let's say it's going to be 40 lakhs. And when it stays the same, it's going to be 50 lakhs. Now, when the value actually goes to 60 lakhs, Pranav is definitely going to benefit from this transaction. Okay. And when the value comes down, Abhishek is going to be beneficial. And when the value is same, Abhishek is going to be the beneficiary. So let me explain how. When the value of the property went high after 6 months, 60 lakhs is the actual market value. But as you can see here in the contract, the value was fixed at 50 lakh rupees. So since Pranav has already paid a premium of 1 lakh rupees, which is non-refundable, plus now the fixed value of the asset was 50 lakhs, Pranav is net paying only 51 lakh rupees for getting the property from Abhishek, whereas the actual market value is at 60 lakhs. So Pranav is actually benefiting by 9 lakh rupees if the value of the property goes to 60 lakhs. The beauty of this contract is that an option seller is obligated to sell the underlying asset, which means he cannot deny Pranav saying that, no, I will not sell it. Once he has got into a contract, he cannot take it back. Whereas the option buyer, which is Pranav, has the capacity to either buy it or deny it. It is his choice. Okay, so now that you've understood the first scenario, now let's go to the second scenario where the value of the property has fallen to just 40 lakh rupees. Now, since the value of the property has fallen to 40 lakh rupees and Pranav has already paid 1 lakh rupees, he will not be willing to buy the property because he will be at a loss. So in simple terms, here Abhishek got 1 lakh rupees for nothing, right? So he's not selling the asset, he's still having the asset, but he still got 1 lakh rupees profit. And even though the value of the actual asset has gone down, it is just notional loss because he still has the asset in his hand, right? So that is the reason why Abhishek is the beneficiary in the second case. Now let's look at the third case where the value of the property is 50 lakhs. Now this is a little tricky for people to understand, but I'm going to try to make it as simple as possible. So pay attention. So now the value of the property is 50 lakhs and Pranav has already paid a premium of 1 lakh. So if he has to buy the property from Abhishek, then he has to pay another 50 lakhs, which means he will be again at a loss of 1 lakh if he buys the property. So there's no point for him to buy it. So instead, he will not buy the property and Abhishek will again be the beneficiary of 1 lakh rupees. So now what you need to concentrate on is not how much money that Abhishek made or Pranav made. What you need to see is as an option buyer, as an option seller, who has higher probability of profit, right? So this is the question you need to ask yourself whenever you're getting into trading, because trading is a game of probability. If you have a very good higher probability and at the same time you manage your risk to reward, then you're going to be net profitable towards the end of your journey. So now in this case, out of 3 situations, 2 times Abhishek was winning, whereas 1 time Pranav was winning, which means Abhishek has a 66.6% probability of profit, whereas Pranav only has 33.3% probability of profit. And Abhishek, being an option seller, has a higher probability of profit, whereas Pranav, being an option buyer, only has a 33.3% probability of profit. Now, the next thing you must be asking me is that who has the unlimited loss potential and who has unlimited profit potential? Now, let's look at the example once again. So in this case of a house, as an option seller, Abhishek has an unlimited loss potential. Here's how. The initial value of the property was 50 lakhs. And he made a contract with Pranav for 50 lakhs. And this value, we also looked at that at one point of time, it went to 60 lakhs. It could have even gone to 3 crores, 10 crores, 15 crores. We never know. So the value of the property could have gone any higher. We do not know how much. So in this case, Abhishek is the person who's taking an unlimited loss potential. So as an option seller, he has a unlimited loss potential. Whereas the maximum profit an option seller can make is to the extent he receives the premium, right? So the premium he received at the start was 1 lakh rupees. So the highest profit he could have made is limited. So unlimited loss and limited profit for an option seller. Now let's look at the option buyer. Now for the option buyer, in simple terms, the highest loss that he could make is 1 lakh rupees that he paid to the option seller, that is Abhishek. So Pranav paid only 1 lakh rupees to Abhishek. So the maximum he could have lost in this case is only 1 lakh rupees, which is limited loss. Okay. However, to the extent of how much Abhishek loses, Pranav has the capacity to make profits. So Pranav has an unlimited profit potential. So to summarize, let's put it this way. An option seller as well as a buyer, we're going to separate in 2 different categories. One is going to be the probability of profit. The second thing is going to be risk to reward. Let me put it as RR. So for an option seller, he has a 66.6% probability of profit by default. And for a buyer, we have 33.3% as a buyer. And when it comes to risk to reward, an option seller has limited profit, whereas an option buyer has unlimited profit. Third is again risk to reward. He has unlimited loss potential, whereas option buyer has limited loss potential. So hope you understood what exactly are the pros and cons of being an option seller and as well as an option buyer. Now, most people looking at this chart are going to say that, oh, an option buyer has an unlimited profit potential. So let me go and start doing option buying. Okay, but here's the biggest myth of option buyers. The capital required to do option buying is very less, because as you saw, to getting into the contract, Pranav only required 1 lakh rupees, but on the other side, Abhishek had to have an asset worth 50 lakh rupees to get into the contract. So similarly, when you're trading in a trading platform with a broker, if you don't have the underlying asset, then the broker is going to request a higher margin from your end. And that is why you will require a higher amount of capital to do option selling without the underlying asset, or even with the underlying asset. But whereas an option buyer, he only requires the premium amount to enter into a contract, which was just 1 lakh rupees in this case. And when it comes to the real markets, it starts with as small as 50 to 100 rupees also, because the premium values are very, very less. But what you need to understand is the concept of edge that we discussed in one of the basics of stock market series. So if you have not watched that video yet, go ahead and check it out. Here, most people get fooled that because option selling has an unlimited loss potential, that they are going to lose a lot of money. They are absolutely right about that part, but there's one part where there's something called as a stop loss. And there's also hedging techniques that one can do to make sure that they're limiting their losses. So even though option selling has an unlimited loss potential, if done the right way, option seller is the one who's going to make money on the long run and be net profitable. Whereas an option buyer, he is going to see that there is an unlimited profit potential, but since he has only a 33% probability of profit, he is most of the times losing the trades. And this messes with the psychology of a trader. So if you're already watching this video, probably you have already done some option trading or you have not done it. It's totally fine if you have not done that. But if you've already done it, then you definitely know that psychology gets messed up very badly. And it's the most important aspect. Psychology is the most important aspect for you to succeed as a trader. Because if you are an amazing trader, has an amazing strategy, but if you don't have the right mindset to deploy those systems in place, time and again, then you won't be able to sustain in the market. And like I've said before, the goal of trading is not to make money on a single day and get out of the markets. The goal of trading is to stay in trading. The goal of any business is to stay in business, right? So if somebody is opening a shop, they would want to stay in business and they would want to expand to maybe more shops. Nobody wants to make more money on a single day and close the shop, right? So hope you are understanding the point. And just to recap of whatever we covered today, we understood what are the different segments in the stock market, right? So we have equities, derivatives, commodities, and currencies. And the second thing we understood is what exactly is a derivative contract, where I gave you an example of milk and butter, where milk is the underlying asset and butter is the contract. So if the value of milk goes up, the value of butter also goes up. And the third thing that we understood today is what exactly is a call option. So in a call option, what happens? We have an option seller as well as an option buyer, and the probability of profit is higher for an option seller. Probability of profit is lower for an option buyer. And when it comes to risk to reward, an option seller has limited profit to the extent of the premium that he receives, and he also has unlimited loss potential. It is notional, but you also have techniques where you can limit those losses. Whereas on the option buying side, you have unlimited profit potential and limited loss, and that limited loss is to the extent of the premium that you have paid. And the most important part, always go for higher probability of profit trades, right? So hope this video was helpful for you. Now, one last thing that I would like to cover before ending this session is when it comes to the call option, it is just like milk and butter. If the value of milk goes up, the value of butter goes up. If the value of milk comes down, the value of butter also comes down. Whereas put option is exactly different, and that is exactly what I'm going to cover in the next episode. So hopefully you had fun understanding what exactly is options in this episode, and I'm going to see you again in the next episode. Thank you. See you again. And if you like the content, go ahead and subscribe for the YouTube channel. Thank you.